In a few hours, when Asian markets open, the first real verdict of the global financial system will be delivered. This is not just another trading session or a routine handoff between time zones. The price action that unfolds tonight will reveal whether recent volatility was a warning shot or a temporary distortion. It will tell us if fear is spreading, if confidence is holding, or if markets are quietly preparing for something bigger. Long before headlines catch up, tonight's Asian Open will show us where capital is truly moving. And once that signal is sent, the rest of the world will follow. Before we continue, if you're getting value from this video, make sure to hit the subscribe button and turn on notifications so you don't miss upcoming updates. And if you have any questions about the markets, silver, or anything you'd like to ask, leave them in the comments. I read every single one, and I'll be answering your questions in the next video. Also, let me know where you're watching from and what time it is there right now. I love seeing how global this community is. I'll catch you in the next one. Precious metals, and silver in particular, are acting as one of the clearest thermometers of global market stress right now. When markets are calm, silver trades largely as an industrial metal, responding to manufacturing demand, technology cycles, and supply fundamentals. But when uncertainty rises, silver begins to behave more like gold, a monetary asset that reflects fear, liquidity conditions, and confidence in the financial system. That shift is exactly what we are witnessing today, and it makes tonight's Asian market open especially important. Over the past month, silver prices in US dollar terms have experienced sharp swings rather than a steady trend. This kind of price behavior is rarely about simple supply and demand. Instead, it signals a market that is struggling to price risk correctly. Large upward moves followed by sudden pullbacks often suggest heavy speculative positioning, forced liquidations, and algorithmic trading dominating short-term price discovery. When silver behaves this way, it is usually because broader markets are under strain, even if equity indices have not yet fully reflected that stress. Asian markets play a unique role in confirming whether these moves are real or temporary. Western trading hours can exaggerate price action due to leverage and derivatives, but Asia, particularly China, is where physical demand and real consumption show up. If silver holds firm or rebounds during the Asian Open, it suggests that buyers with long-term intentions are stepping in. If prices weaken sharply as Asia opens, it often means that the prior rally was driven more by speculation than by fundamental demand. This is why silver is often referred to as an early warning signal. Historically, when silver begins to outperform dramatically or becomes unusually volatile, it tends to precede broader market adjustments. It can foreshadow tightening liquidity, stress in funding markets, or growing doubts about economic growth. In many past cycles, silver sent its message before equities, credit markets, or even currencies reacted. Investors who ignored it often did so at their own risk. Right now, silver is reflecting a world caught between competing forces. On one hand, inflation concerns, geopolitical uncertainty, and rising sovereign debt are pushing investors toward hard assets. On the other hand, higher interest rates, strong dollar periods, and slowing industrial demand create headwinds. The tension between these forces is being resolved in real time through volatile price action, and tonight's Asian Open may tip the balance one way or the other. If Asian buyers validate recent price levels, it would reinforce the idea that silver's strength is signaling deeper systemic concerns, not just short-term speculation. That would have implications far beyond metals, potentially affecting currencies, equities, and capital flows. If Asian markets reject current prices, it would suggest that recent moves were premature and that markets may attempt a temporary return to stability. Either way, silver is speaking. And tonight is when we find out whether the message is being heard globally. Volatility is no longer a side effect in today's markets. It has become a defining feature. When price ranges widen dramatically and markets swing sharply within hours rather than weeks, it tells us something important about liquidity and confidence. In the current environment, silver's recent behavior highlights this perfectly. Large intraday moves, sudden reversals, and gaps between sessions are signals that traders are reacting emotionally to uncertainty rather than responding to stable fundamentals. This kind of volatility demands a different mindset from investors, especially as global markets approach critical decision points like tonight's Asian Open. High volatility often reflects a breakdown in consensus. In calmer markets, prices move gradually as participants broadly agree on valuation. But when volatility spikes, it means buyers and sellers no longer share the same expectations. Some are positioning for crisis, others for recovery, and the resulting conflict produces sharp, erratic moves. Silver's recent trading range shows this clearly. Prices have surged on fear-driven narratives and then retreated just as quickly when sentiment shifts, creating an environment where timing errors are severely punished. The Asian market open plays a crucial role in either amplifying or stabilizing this volatility. Asia represents a transition between trading sessions, where liquidity conditions reset and new participants enter the market. If volatility expands immediately after the Asian Open, it suggests that uncertainty is spreading globally rather than remaining isolated in Western markets. This kind of behavior often leads to follow-through volatility in Europe and North America, as traders adjust positions based on overnight signals. For investors, this environment places risk management at the center of every decision. Volatility does not simply increase potential returns, it magnifies losses just as quickly. Rapid price swings can trigger stop losses, margin calls, and forced liquidations, especially in leveraged positions. When these mechanical selling pressures appear, they can overwhelm fundamentals and create self-reinforcing downward moves. Understanding this dynamic is essential because markets driven by forced selling tend to overshoot on the downside before stabilizing. Another important aspect of volatility is its impact on confidence. Persistent sharp swings erode trust in price signals, making participants hesitant to commit capital. When confidence weakens, liquidity thins, and thin markets are inherently more volatile. This feedback loop can persist until a clear directional signal emerges, often during a key session such as the Asian Open. A calm, orderly Asian session can act as a stabilizing force, while disorderly trading can confirm that uncertainty remains unresolved. Volatility is a message rather than a problem to be ignored. It tells us that markets are searching for a new equilibrium in response to shifting economic, monetary, and geopolitical realities. Tonight's Asian market open will help determine whether volatility begins to compress, signaling a potential return to stability, or whether it expands further, warning that global markets are entering a more fragile phase. In times like these, disciplined positioning, patience, and respect for risk matter more than chasing short-term price moves. China's influence on the silver market is often underestimated, but in moments of stress or transition, it becomes impossible to ignore. Unlike Western markets, where silver is heavily traded through paper instruments such as futures and ETFs, China places a much stronger emphasis on physical metal. This distinction matters because physical demand acts as an anchor for price, while paper markets can amplify volatility through leverage. When prices diverge sharply between regions, it usually signals a deeper imbalance beneath the surface of the global market. In recent periods, silver prices in Chinese markets have traded at noticeable premiums compared to international benchmarks. These premiums are not arbitrary. They reflect a combination of factors: domestic demand, import restrictions, currency considerations, and strategic stockpiling by institutions and industries. When Chinese buyers are willing to pay more than the global spot price, it suggests that silver is being valued not merely as a trade, but as a resource worth securing. That kind of behavior tends to emerge when confidence in broader financial conditions weakens. The Asian market open is the moment when this reality confronts global pricing. If Shanghai and Hong Kong trading sessions absorb supply and stabilize prices, it signals that real demand exists at current levels. That confirmation often forces Western markets to reprice accordingly. On the other hand, if Asian buyers step back and allow prices to fall, it suggests that recent strength may have been driven more by speculative enthusiasm elsewhere than by genuine consumption or long-term accumulation. China's role is also tied closely to industrial demand. Silver is a critical input for sectors such as electronics, solar energy, and advanced manufacturing, all areas where China plays a dominant global role. When economic growth expectations shift, silver demand expectations shift with them. Strong participation during the Asian session may indicate confidence in continued industrial activity, while weak participation could hint at slowing growth or cautious inventory management by manufacturers. Beyond pure economics, there is also a strategic dimension. Precious metals have historically played a role in hedging against currency risk and financial instability. As global trade becomes more fragmented and geopolitical tensions persist, countries with large manufacturing bases and export exposure have incentives to diversify reserves and reduce reliance on purely financial assets. Silver, while less discussed than gold, fits into this broader strategy due to its dual monetary and industrial nature. Tonight's Asian Market Open is therefore more than a regional event. It is a referendum on whether physical demand, industrial necessity, and strategic thinking are strong enough to support current silver prices. If China validates the market, it strengthens the case that silver is signaling deeper global shifts. If it does not, it warns that recent moves may lack a durable foundation. Either outcome carries implications far beyond metals, influencing currencies, equities, and global risk sentiment in the days ahead. Silver occupies a unique position in the global market because it exists at the intersection of industry and finance. Unlike gold, which is held primarily for wealth preservation and monetary purposes, silver is consumed. It is embedded in products that power modern life, from electronics and medical equipment to renewable energy technologies. This dual identity makes silver especially sensitive to changes in economic expectations, and it is why price movements often carry broader signals about global growth and investment confidence. When silver prices rise steadily, industrial users can generally absorb higher costs by passing them through supply chains or by improving efficiency. However, when prices surge rapidly or swing unpredictably, manufacturers are forced to change behavior. They may delay purchases, draw down existing inventories, or substitute materials where possible. These decisions reduce immediate demand and can introduce sudden weakness into the market, even if long-term fundamentals remain intact. In this way, excessive speculation can temporarily overpower genuine industrial need. This tension becomes visible during key trading sessions, particularly the Asian Open, where many industrial buyers operate. If prices remain stable or recover as Asia begins trading, it suggests that industrial demand is resilient and willing to support higher price levels. If prices weaken sharply, it may indicate that manufacturers are stepping back, waiting for clarity, or resisting elevated costs. That response matters because industrial demand provides a base layer of support that speculative flows alone cannot replace. Speculative activity, on the other hand, tends to react quickly to headlines, momentum, and macro narratives. While speculation can accelerate price moves, it is inherently fragile. When expectations change, speculative capital can exit just as fast as it entered, leaving prices exposed. This is why markets driven primarily by speculative enthusiasm often experience abrupt reversals. Silver's recent volatility reflects this push and pull between real-world consumption and financial positioning. The Asian Market Open offers a rare window into which force is dominant. It is the point where speculative momentum meets practical reality. If industrial demand asserts itself, prices may stabilize and send a signal that recent moves have a solid foundation. If speculation unwinds without sufficient industrial support, prices may continue to fluctuate as the market searches for balance. Understanding this dynamic is critical for investors. Silver is not simply rising or falling. It is negotiating its identity in real time. Tonight's session will help reveal whether silver is being priced as a strategic industrial resource, a speculative vehicle, or a blend of both. That distinction will shape not only silver's path forward, but also broader signals about economic strength and market confidence. Silver does not move in isolation, and neither do the markets reacting to it. When capital flows into or out of precious metals, it often reflects deeper shifts in the macroeconomic landscape. These shifts influence currencies, interest rates, equity markets, and even government bond yields. That is why movements in silver, especially during pivotal sessions like the Asian Open, can act as early indicators of broader financial stress or relief. One of the most important relationships to watch is between silver and the US dollar. Because silver is priced globally in dollars, changes in dollar strength directly affect its price. A weakening dollar tends to support higher silver prices, while a strengthening dollar can pressure them. However, during periods of heightened uncertainty, silver can rise even alongside a strong dollar, signaling that investors are prioritizing capital preservation over yield. If the Asian market opens with renewed buying in silver despite stable or stronger dollar conditions, it may indicate growing concern about global financial stability rather than simple currency dynamics. Interest rates and bond yields are another critical part of the picture. Rising yields generally make non-yielding assets like silver less attractive, as investors can earn returns elsewhere. Yet when markets fear economic slowdown, recession, or systemic risk, demand for safety can override yield considerations. If silver holds firm while yields fluctuate or fall during Asian trading hours, it may suggest that investors are reassessing risk across asset classes. That reassessment often spreads quickly into equities and credit markets. Asian equity markets themselves provide valuable context. Strong equity performance alongside stable silver prices may indicate confidence in growth and orderly risk-taking. In contrast, falling equities combined with rising or resilient silver prices often signal defensive positioning. This pattern reflects investors moving away from risk assets and toward hedges. Because Asia opens first, these signals frequently set the tone for European and US markets later in the day. Currency markets in Asia also matter. Movements in major regional currencies can influence trade balances, capital flows, and commodity demand. If local currencies weaken while silver remains strong, it may reflect domestic investors seeking protection from purchasing power erosion. That behavior can amplify demand for hard assets and feedback into global pricing. Such dynamics are rarely confined to one region. They tend to ripple outward, affecting global sentiment. Geopolitical and policy risks add another layer of complexity. Trade tensions, fiscal pressures, and uncertainty around central bank policy can all drive investors toward safe haven assets. Asia, with its mix of emerging and developed economies, often reacts quickly to these risks. A cautious or defensive Asian Open can signal that global investors are bracing for instability, even if official headlines remain calm. The key takeaway is that silver's performance during the Asian Open cannot be viewed in isolation. It is part of a web of interconnected signals that reveal how investors are positioning themselves for the future. If silver aligns with defensive moves in currencies, bonds, and equities, it strengthens the case that global markets are entering a risk-averse phase. If these signals diverge, it may suggest temporary dislocations rather than systemic stress. For investors, recognizing these cross-market relationships is essential. Tonight's Asian session may provide early clues about whether the current environment is shifting toward caution or stabilization. Those clues, subtle as they may seem, often precede larger moves across global markets. At the heart of every market move lies human behavior. Charts, models, and algorithms may dominate modern trading, but they are ultimately driven by fear, confidence, and expectation. When markets reach moments of uncertainty, psychology becomes more influential than fundamentals. That is why trader sentiment during key transition periods, such as the Asian market open, can determine not just short-term price direction, but the broader narrative that unfolds across global markets. Markets rarely move simply because of new information. More often, they move because of how participants interpret that information. When confidence is high, investors are willing to look past negative data and focus on long-term opportunities. When confidence erodes, even neutral news can trigger selling. In the current environment, sentiment appears fragile. Recent price swings in silver and other assets suggest that many participants are positioned nervously, reacting quickly rather than acting with conviction. The Asian Open is psychologically important because it represents a reset. Positions established during Western trading hours are tested as a new group of participants enters the market. If prices hold or strengthen, it reassures traders that the prevailing narrative remains intact. If prices reverse sharply, it creates doubt. That doubt can spread quickly, influencing decision-making well beyond Asia. Traders in Europe and North America often interpret Asian price action as an early vote on market confidence. Liquidity plays a critical role in this process. During periods of thin liquidity, price movements can appear exaggerated, which in turn amplifies emotional responses. Sudden drops can feel more threatening than they truly are, while sharp rallies can create a false sense of security. When traders see aggressive moves during the Asian Open, they often assume that someone knows something, even when that may not be the case. This perception alone can be enough to trigger follow-on buying or selling. Fear tends to express itself through speed. When participants are anxious, they prioritize exiting positions quickly rather than waiting for confirmation. This behavior can lead to cascading sell-offs or abrupt reversals, especially in leveraged markets. Greed, by contrast, often shows up as complacency, where risks are ignored and positions grow crowded. Both extremes are dangerous, and markets frequently swing between them during uncertain periods. Silver, given its dual nature as both a monetary and industrial asset, is especially sensitive to these psychological shifts. When fear dominates, silver can attract defensive flows as a hedge against instability. When greed dominates, it can become a momentum trade detached from fundamentals. The challenge for investors is distinguishing between these phases in real time. Tonight's Asian Open may provide that clarity by revealing whether participants are acting defensively or speculatively. Another key psychological factor is trust in the system. When traders believe that markets are functioning smoothly and policymakers have control, they are more willing to take risk. When that trust weakens, capital begins to seek safety, even at the expense of returns. Persistent volatility, unexpected price moves, and regional divergences all chip away at confidence. The more these signals accumulate, the more psychology shifts toward preservation rather than growth. What makes tonight particularly important is that markets appear to be standing at a psychological crossroads. A calm, orderly Asian session could help restore confidence, signaling that recent volatility is being absorbed. That outcome would encourage participants to re-engage with risk assets and reduce defensive positioning. A disorderly or sharply negative session, however, could reinforce fear, convincing traders that instability is spreading rather than resolving. For investors, understanding this psychological dimension is essential. Markets often turn not when fundamentals change, but when perception does. The tone set during the Asian Open may influence how risk is priced for days or even weeks ahead. In moments like this, patience and awareness matter more than prediction. Watching how markets behave rather than what they say can provide the clearest insight into what comes next. Tonight's Asian market open is not just about prices, it is about confidence, conviction, and the collective mindset of global participants. Whether fear or confidence greets the opening bell may determine the path markets take in the near term, making this session one of quiet but significant importance.